Hey guys, I'm just going to do this video on Technical Review 17.6. One of the reasons I chose to do this video, or rather to do this question in specific, is because I feel that this question is actually quite poorly worded and confusing, and frankly badly set up in places on Connect. It really got me stumped when I was doing it for the assignment, so I thought it would be a good video to do to help us study for the midterm. And if it helps you guys too, I'm glad to hear that. Um, these cells right here are set up to help me link cells together. They're not necessary for the question. They're more so I can focus on the technical aspects of this question and not on how to program Excel. So you can kind of just ignore these. Next, we're given some information on a company called Jupiter Limited. We're shown these simplified financial statements, and we're asked in the first part of the question, what's the amount of taxable income or loss in each year? And this is actually fairly similar to stuff we've already done. It's basically right out of chapter 16. We're going to pull the numbers out of here, and we're going to use them to fill in this simplified little income statement that I've made. So in 2007, we had income of 96,000. In 2008, we had a loss of 360,000. Each year we had non-deductible tax expenses of 34,000. And those would be like your golf dues or your political contributions, whatever those are. Things that aren't deductible for tax purposes, but that we have to try to deduct and now have to add back in. We took $52,000 of depreciation in each year. And in year 2007, we had $65,000 of CCA. And in 2008, we had $117,000 of CCA. So right away, we can see the answers to part one. I do have these sort of set up to auto sum the columns and to calculate the amount of taxes payable. So we can see right away that we had taxable income of $117,000 in 2007. We had a loss of $391,000 in 2008. And in 2007, we paid taxes of $29,250. And that's what we need to know for part one. We're not technically asked to calculate this. I just thought it looked good on the income statement. So in part 1b, we're asked, what's the amount of the loss carry forward at the end of 2008? And that's simple enough to figure out. All we have to do is sum our taxable income and our loss. And we can see that we have $274,000 available to carry forward up to 20 years to cover any future gains so we can get a tax refund. However, when we move on to part two, we're going to see that they want us to prepare a journal entry for 2008, assuming the probability of loss carry forward is low. And what that means for us as a company is that we think we're going to go out of business. We don't think we'll ever have any future profits that we can use this carry forward on. This loss here kind of sank us. So we just need to do an income, we're going to do a journal entry assuming that we're not going to ever have profits in the future. And to do that, we're going to you can kind of cheat because I have filled the parts of it out here. So the first thing you can see, the first part of our journal entry is income tax receivable. We easily have a sufficient loss to cover our entire gain in 2007, which means we can recover the entirety of the taxes we paid, the full $29,250. So we can just link those cells together right now, and we can be 1/3 done our journal entry. Next, we have to calculate the amount of the deferred income tax, specifically the deferred income tax in 2008, because even though we had a loss, we still owe taxes on those assets. The government is going to get their money no matter what. So we need to calculate what our deferred income tax is. And this was the first part of this question that I feel is kind of poorly worded, because in Connect, it tells you that this is an asset. And you can see just by looking at this, because our depreciation is lower than our CCA, this is actually a liability. It's not an asset. It's going to end up with a negative, a credit balance. And it did confuse me because it did insist to me that this was an asset. So what we're going to do is we're going to do the full temporary difference charts for the capital assets for both years. So the tax basis, as you remember, is how much does the government think this asset is worth? In this case, the government thinks it's worth the 1.3 million we paid for it minus the amount of CCA. We, the accountants, think this asset is worth the 1.3 million minus the 52,000 in depreciation we took. And this is going to give us a temporary difference, and we find the temporary difference by subtracting the accounting basis from the tax basis. This is going to give us a temporary difference of $13,000. So the government thinks this asset is worth $13,000 more than we took. And they're right. They're going to get their money eventually because they're the ones who decide how many taxes we pay. So even though we didn't take the full amount of CCA we could have taken, we didn't take the full amount of depreciation we could have taken. We could have taken up to $65,000 of depreciation, but we didn't. And because we didn't, we created this temporary difference, and we're on the hook for that. Or rather, we're on the hook for 25% of it in taxes, or $3,250. So another way of looking at this is through the T account. So at the beginning of 2007, we didn't have any assets, and we had a zero balance in our deferred tax account. Then we created this temporary difference when we took a different amount of CCA than depreciation. So now we're on the hook for this $3,000 in taxes, and we need to acknowledge that in our books. So at the end of year one, we're on the hook for $3,250 in taxes. So now we come into year two, in this case 2008. And remember that all of this accumulation, the depreciation and CCA will accumulate. So now the government thinks this asset is worth 1.2 million minus 117,000. And we think the asset is worth the 1.2 million minus 52,000. And this is going to give us a new temporary difference, this time of $78,000. So now we're on the hook again. We're on the hook for even more taxes. Now we're on the hook for $19,500. So we will eventually have to pay this 25% of $78,000. That's where we got this number. So at the end of year two, we're on the hook for even more taxes. We owe the government $19,500 in taxes that we're going to have to pay at some point in the future. And now we need to adjust this value upwards. We had this at the beginning of the year, and at the end of the year we have more. So we need to make an adjusting entry here to get 3,000 up to the 19,000. And to see how much the amount of our adjusting entry is, we can subtract 3,000 from our 19,000. And we're going to get the adjustment of 16,250. And you can see that here. And because this is negative, it's a credit or a liability. So we can simply just link this here. So the amount of our deferred income tax is a liability of 16,250, which means the income tax we can recover will actually be lower, the expense recovery. And this entry here is a plug. So that is the whole entry for year one. So now we're going to move on to year two. Sorry, not year two. Part two of the question. And part two of the question is a little complicated, and frankly, this is the part I feel was very poorly laid out. We're asked, what's the amount of taxable income or loss in each year, assuming that Jupiter decides not to claim CCA in 2008 and 2007. So we're just going to fill out this chart exactly like we did before. We had an accounting income of 96,000. And in 2008, we had the same loss of 360,000. We had the same non-deductible expenses of 34,000. We had the same depreciation of 52,000. But this time we had a zero CCA in both accounts. So this is set up exactly the same way. It's the sum of our taxable income and our loss. So the amount of our loss carry forward in this case is $92,000. Now, here's sort of where it gets confusing. The temporary differences for our capital assets in 2007, basically, the best way that I can put this is the question literally is lying to you. We actually did take CCA in 2007, and we're going to set this up exactly the same way as before. So even though it says we didn't take any CCA in 2007, we actually did take it. So our asset is worth 1.3 million minus the CCA, and on an accounting basis, it's 1.3 million minus the depreciation. It's going to give us the same temporary difference as in part 1, the same deferred taxes in part 1, and the same adjustment as in part 1. And actually, let me just copy these down so we can do this T account. So another important thing to remember in this specific case is that we actually did take this CCA, so that in part 1, even though this is the answer it wants when you fill out the income statement, this isn't actually the correct answer in terms of what we really did. We took that CCA of $65,000, so we actually did pay the same $29,250 in taxes. So in a sense, this is actually going to be the same. The income tax we can recover is going to be $29,250 because we actually, despite what the question says, did take that CCA in 2007. Now in 2008, we decide to, and I'm not sure how to put this, and the teacher's explanation wasn't great either. We basically decide to reverse taking the CCA, which we're allowed to do. The asset reverts to its original value, 1.3 million. But we don't stop taking the depreciation, so that continues to accumulate. We subtract the $52,000 from this number here, giving us a much larger temporary difference than before. We have a temporary difference of $104,000, and this creates an asset. This is taxes we paid that now we don't have to pay anymore. So in the future, this $26,000 is essentially a prepayment of tax. So if you want to look at this from the perspective of the deferred tax account, on December 31st at the year 1, we had the same balance in the deferred tax account, a credit balance of $3,250. On December 31st, year 2, and actually, it might be better to put it in this square. On December 31st, year 2, we had a deferred tax debit balance of $26,000. Just make that money. So now we need to make an adjustment. We basically need to plug this hole of $3,250 and get us up to $2,600. And to figure out what the adjustment is, we can simply add these two numbers. So we need to make a debit adjustment in this case of $29,250. So if you think about that, we've essentially used $3,250 of that to plug the hole, and the remaining $26,000 to get us up to the amount we need. And in this case, it's an asset. And we can actually just link this cell, which means our income tax expense recovery is going to be higher. It'll be a plug again, and it's just going to be our debits plus our debits so that we can balance. And sort of that's how this question works. And this part was just super confusing to me, and that was why I chose to do it. And I hope this helped.